Welcome. Welcome to the Consumer Financial Protection Bureau's public meeting of its Credit Union Advisory Council, or CUAC. My name is Zixta Martinez. I am the Associate Director for the External Affairs Division at the Consumer Financial Protection Bureau. Today's public meeting is being held at the CFPB's headquarters in Washington, D.C. This is the CUAC's second public meeting of the year, and as always, we have a packed schedule. Today's public meeting is being recorded and will be available at consumerfinance.gov. You can also follow CFPB on Facebook and Twitter. Let me spend just a few minutes telling you about what you can expect at today's public meeting. First, I'll introduce the Bureau's CUAC members. For some of them, this will be their first public meeting with the CUAC, and we are happy to welcome the new and returning members to the Advisory Council. Following introductions, the CFPB's Director, Richard Cordray, will provide opening remarks. Following the Director's remarks, the new CUAC Chair, Kevin Foster-Getty, will conduct the meeting, and he will introduce Will Wade Gary and Gary Stein, subject matter experts in the Bureau's Division of Research, Markets, and Regulation. The two will provide an overview of the Bureau's guiding principles for faster payments and lead a discussion with council members on the subject. The public meeting will adjourn at about 4:30 p.m. The Bureau established a Credit Union Advisory Council that includes representatives of credit unions from throughout the U.S. The CUAC has provided substantive information, analysis, operational expertise, knowledge of community, and feedback that has served to better inform the Bureau's policy development, rulemaking, regulatory implementation efforts, and consumer engagement work. Today's public meeting and discussion is in support of this important responsibility. As a reminder, the views of the CUAC members are their views, and they are greatly appreciated and welcome. However, they do not represent the views of the CFPB. So let's get started with an introduction of our CUAC members. The chair is Kevin Foster-Getty. Kevin is President and CEO of Washington State Employees Credit Union in Olympia, Washington. The vice chair is Robin Romano. Robin is Chief Operating Officer of Marisol Federal Credit Union, a CDFI credit union in Phoenix, Arizona. Gregory Higgins is Senior Vice President, Chief Administrative Officer, and General Counsel of Wings Financial Credit Union in Apple Valley, Minnesota. Maria Lavelle is the CEO of Westmoreland Community Federal Credit Union in Greensburg, Pennsylvania. Jason Lee is Executive Vice President and CFO for Orion Federal Credit Union in Memphis, Tennessee. Robin Loftus is Chief Operating Officer of Heartland Credit Union in Springfield, Illinois. James McDaniel is President and CEO of Heritage Trust Federal Credit Union in Charleston, South Carolina. Carrie O'Connor is Chief Lending Officer for Community America Credit Union in Lenexa, Kansas. Thomas O'Shea is President and CEO of Aspire Federal Credit Union in Clark, New Jersey. Katie Prefke is Assistant Vice President and Compliance Officer for Chevron Federal Credit Union in Oakland, California. David Seeley is President and CEO of Kirkland Federal Credit Union in Albuquerque, New Mexico. Jim Spratlin is President and CEO of Park Community Credit Union in Louisville, Kentucky. Bernie Wynn is President and CEO of the Boston Firefighters Credit Union in Dorchester, Massachusetts. We also have with us Matt Cameron, CFPB Senior Advisor for the Bureau's Advisory Board in Counsel's Office. I'm now pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, he led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray?
Thank you, Zixta. I want to welcome all of you to this meeting of the Credit Union Advisory Council, which has been convened to talk about consumer challenges in payment systems. I especially want to extend a warm welcome to the newest members of the council who've been joining us for the first time since their appointment this year. And I would like to thank in particular Kevin Foster Ketty for assuming the role as chairman and Robin Romano for assuming the role as vice chair. We have had and will have many good discussions, and we have much good work ahead of us. As the director of the Consumer Financial Protection Bureau, I recognize the importance that credit unions play in the lives of many consumers and in many neighborhoods and small towns across the United States. The Consumer Bureau is well aware that credit unions were not one of the causes of the financial crisis. You were not underwriting the bad loans that brought down the housing market. Instead, you were sounding the alarm bells well before the sinking of the economy. We started this advisory body to give us more insight into the daily operations of credit unions. Over the past few years, we've come to rely on it as a key source of information, analysis, and recommendations to better inform our work. Today, we would like to learn more about what you have to say about electronic payment systems and the faster payment systems that seem to be imminent in our financial system. We want to hear what you think are the challenges for consumers, and we want to hear what you think are the challenges for credit unions. As you know, when consumers are making payments, whether it is to pay regularly scheduled mortgage debt or simply to buy a cup of coffee, they have multiple options. These may include paying in cash, writing a check, swiping a credit or debit card, and entering information online for an electronic payment. In general, non-cash payments are primarily processed through one or a combination of payment systems, including the Automated Clearinghouse, known as ACH, PIN debit, the credit card network, wire network, or check services. For these non-cash payments, there can be a delay of anywhere from several hours to several days between the time when the consumer initiates a transaction and the time when the other party actually receives the money. And it is important to note that all existing payment systems, including those involving cash, expose consumers to some risk of loss or to the security of their information, including in some cases risks of unauthorized or fraudulent debits. As credit unions are aware, the payment system participants, including payers, payees, providers, institutions, and operators, are subject to regulations that were adopted to ensure more consistency and predictability to all the parties involved. In general, these systems work pretty well. But as we've worked on these issues at the Consumer Bureau, we've come to believe there's room for improvement, and we found that most in the industry would agree. Specifically, we have three primary areas of concern: transparency, security, and access. First, we believe transparency can be improved within the electronic payments space to help consumers make more informed decisions and take greater control of their economic lives. When consumers make a deposit into their credit union account, it's often difficult for them to know when the funds will be actually available. This is most often the case when consumers deposit a check. For some, these uncertainties are of little consequence because they're able to maintain a healthy cushion of funds in their accounts. But many other consumers struggle to keep up with their expenses, and they have no such cushion. Not knowing when a payment will be credited or debited can cause significant confusion and anxiety for those whose credit union accounts can be precariously low on funds. Toward the end of a pay period, many consumers find themselves playing a high-stakes game of chance without being able to understand or control the exact timing of their payments. Too frequently, the results for these struggling consumers include a set of expenditures they can ill afford: the high costs of overdraft and non-sufficient funds, or NSF fees. Consumers deserve better. They deserve transparency. They deserve to know exactly where their money is so they can make informed choices about how best to manage the ways and means of their lives. Second, the Bureau sees room for improvement when it comes to protecting consumers from loss, theft, or mistreatment that may arise from payment security problems. The ACH system, as it currently operates, depends on the routing and sharing of sensitive account details. While seemingly benign, this routine practice can be fraught for consumers. It can expose them to great risks, particularly if unscrupulous people or businesses are granted access to their hard-earned money. When bad actors take advantage, consumers can find themselves paying for charges they never authorized. Sometimes they can find their accounts subject to ongoing phishing expeditions as repeated and expensive attempts are made to collect a payment. When this happens, consumers expect their own credit union to be on their side. Unfortunately, we know that institutions cannot always provide them with adequate protection, such as successful stop payments, notices of revoked authorizations, and an effective block on repeated attempts to process payments from the same source. The Bureau wants to make sure that consumers are protected from getting stuck in such situations. Consumers should not be subjected to unauthorized payments or phishing expeditions. And in situations where they're being victimized, consumers need to be able to reverse the unauthorized charges or prevent the unauthorized billings. Our third concern has to do with access, and we believe there's room for improvement here too. Electronic payment systems are critical pieces of our financial ecosystem today. They make our modern lives much more convenient, from making automatic monthly car payments to being able to use a card at the corner store to buy a loaf of bread. However, a substantial number of consumers have no access to electronic payment systems and the benefits they provide. Indeed, the current payment systems do not seem to be meeting all the real-world needs of certain consumers. According to a recent FDIC study of the unbanked and underbanked, almost 1 in 5 consumers with incomes under $15,000 report having used a check casher, as do 1 in 6 consumers with incomes between $15,000 and $30,000. When these consumers receive checks, they typically fork over up to 3% of the face value to get immediate, no-recourse access to their money. For other consumers living on the edge, and millions upon millions of Americans do so, using check cashers or money order services is their primary way to avoid costly late fees on their phone bills or rent checks. Because they lack an account that permits them to make their payments electronically, these consumers forego many federal protections and can spend more time and money paying their bills than other consumers who have bank or credit union accounts. The Consumer Bureau has been persistently advocating for the development of faster and safer consumer payment capabilities in new and existing payment systems. During today's discussion, we would like to hear from you about how credit unions are experiencing issues in the payment space. Among our discussion topics, we want to know what you think about some key questions. What are small financial institutions doing to accommodate and improve consumer needs? What new developments are your institutions currently involved in? If your institution is not involved, what are the barriers to entry and how can you bring your perspective to the table? We're now seeing companies in the fields of technology and finance that are beginning to develop real-time or near real-time payment systems for the American economy. These new systems are aimed at reducing pocket-to-pocket payment times between consumers and businesses or other entities. The Bureau recently outlined some guiding principles to govern these new systems as they're being developed. We want to ensure that consumer protections are at the forefront. So our principles, which we'll be discussing today, relate to areas such as funds availability, resolution protections for fraud and error, and payment system accessibility. We think it's reasonable to expect that the greatest economy in the history of the world, which has given rise to some of the most sophisticated technology that human beings have ever seen, would have an electronic payment system that we can all be proud of. That system should be one where people can get access to their hard-earned money in real time. Their transactions are completely transparent. They know their money is secure, and they can get their money back if a payment is erroneous or unauthorized. These features would make an already impressive payment system even better. It would restore trust. It would bring more people into the fold, and it would simply be good business. I look forward to engaging in this important discussion. Thank you.
Well, thank you, Director Cordray and Zixta, and welcome again to the second meeting of the 2015 of the CFPB's Credit Union Advisory Council. I'd like to welcome members of the public, as well as new and returning members of the Advisory Council. The CFPB was organized, this council, in 2012 as a means to hear regularly from credit unions from all over the country, and I believe this has been a productive exercise. This advisory council has provided an opportunity for credit unions to raise emerging issues facing them and share their input and perspectives on the Bureau's work to protect consumers. During this afternoon's meetings, we will hear from council members on consumer challenges they have encountered in the payment space, with a special focus on the new faster payment systems the private sector is seeking to develop. First, we will hear from the CFPB staff, Gary Stein and Will Wade Jerry, who serve as the Bureau experts on these matters. Then, we will shift over to a discussion with council members to gain their perspectives on what are some of the key issues for credit unions and where the CFPB ought to be focusing its attention. During that time, I'll ask council members to share their thoughts and opinions, as well as ask questions on these important topics. Before we begin today's discussions, I'd like to invite Gary Stein, the CFPB's Deposits Markets Program Manager in the Office of Credit Information Collections and Deposits Markets, and Will Wade Jerry, the CFPB's Assistant Director in the Office of Card and Payment Markets, to provide a brief update on the work the CFPB has been doing to encourage strong consumer protections for faster payment networks.
Thank you very much. As the director indicated in his opening remarks, we see great value and benefit to consumers with the advent of a new, faster payment system. And as such, we've been advocating for one and are pleased to be participating with other stakeholders in the marketplace to help make that a reality. Several technology providers, institutions, and other stakeholders have been working to develop newer real-time payment systems. And we recognize that this is an opportune time for us both to lend support to these efforts and also to help inform them so that the fruits of their labors come out and are really beneficial and to consumers, both from a utility and a safety means. And we recognize primarily that if we can help indicate where we think consumers will require protection while they are designing the systems, we can arrive at payment systems that meet consumer needs and serve consumers best in the most cost-effective manner. As a result, in July of this year, we published a set of guiding principles related to faster payments. We've done this in conjunction with work that we also do with the Federal Reserve and a number of other stakeholders on their task force for faster payments. I sit on the task force steering committee, and Will Wade Gary, my colleague here, sits on the task force for the Fed's secure payments. And as a result, both of those task forces are at work defining criteria that will also help to inform these new faster payments. We thought it was important that the Bureau provide its insights and thoughts early on in this process to help move that along. So as Director Cordray mentioned in his remarks, we see great promise for consumers with faster payment systems. Just to recap briefly, today, while we have a great abundance of different payment choices, none of them are real-time or near real-time. And as a result, there's always some time at which consumers may be uncertain to the status of their funds when making a payment. And for a consumer that does not have a lot of liquidity, is making a lot of payments, that uncertainty can result in costs. Making payments either on overdraft or when they don't have enough money, or can result in some payments being returned. So we see great value in providing greater transparency to consumers. The faster that funds move and the faster that consumers who receive funds have access to them, the greater liquidity and they gain from that funds availability. We also see, however, in the advent of these new faster payment systems, not just benefits related to speed, but opportunities to improve some of the issues that we recognize with some of our more legacy payment systems. We've all heard about breaches related to card payment systems, and there's certainly opportunities to design something that's safer from that regard. And then finally, there is an opportunity, we believe, to use these development of payment systems and faster funds availability and addressing some of the issues that consumers contend with today to invite greater access to those that aren't participating in electronic payment systems. So I'm going to quickly walk through the 9 guiding principles and describe our thinking along them. Importantly, all of these principles have been informed through our observations and work on existing payment systems. We recognize that some current payment systems, or probably none of them, meet all of these principles today, and in some sense they're aspirational. We also recognize that these aren't necessarily always easily built and offered, and there will be some trade-offs. But we feel it's important to recognize what consumers really need and value and should have, and help push the industry to shoot for these things. The first one, consumer control over payments. And this is really ensuring that consumers, when they make a payment, have both the clarity and the ability to ensure that payment's going to the right payee for the right amount, the right time, for the right purpose, etc. A lot of that points back to how consumers authorize the payments that they make and the clarity of detail that's in those authorizations. Consumers should have the ability to determine when they want to make payments, when payments should not go through, and ideally we can achieve this in a way that both lets consumers know when they are making a payment, but also continue to enjoy the benefits that many consumers have today in setting up recurring payments so that they can meet their obligations on a timely basis. The second principle is actually one of the more difficult ones that we wrestle with, and I'll present it primarily conceptually, and it relates to data and privacy. We expect that any new payment systems that are developed are going to have robust information capabilities that will help all payees and payers, consumers and commercial, to understand the nature of the payments, to make sure that they are indeed valid, and to permit some sort of post-payment monitoring and reconciliation and analysis should things go awry. There's a lot of insight to be gained with how consumers make payments. A lot of it can benefit consumers, information used for fraud protection algorithms and things like that. But it's important that consumers have a say in how their information is being used. When feasible, that they specify what information is being collected about them, and for what purposes and to which parties. And this pertains really all the way through. As the director mentioned, we're looking at payments from a pocket-to-pocket standpoint, and there may be multiple different entities involved, from the consumer's account provider to an operator and to other third parties in between. The challenge here is that if you leave the control completely up to the consumer may not always make decisions from an informed basis. We may not appreciate how information we think could only benefit marketers might also be used to protect us from fraud. And so we see this as a difficult line drawing exercise, but it's important to ensure that all providers are shooting for the same objective. The third one relates to fraud and error resolution protections. Today, consumers that utilize electronic payment systems receive the benefit of Electronic Fund Transfer Act and Regulation E, which provides a framework and rules related to the dispute of unauthorized transactions. Consumers making payments from credit accounts also benefit from the Truth in Lending Act and Regulation Z. We would anticipate that any new payment system will certainly be electronic. I don't know if there's such thing as a nuclear payment system, and would also carry the protections of Reg E and Reg Z. Importantly, we want to make sure that the payment systems go as far as they can to help consumers. The faster that payments move, the more likely it is that a payment could be made inadvertently to the wrong party or for the wrong amount and so forth. And so in addition to the regulatory protections of E and Z, it'll be important that the payment system inherently provides features that help consumers resolve payments made in error. And that points back to what I mentioned earlier about having the robust information monitoring capabilities that enable payment providers to do the forensic analysis to see what happened, to identify fraudsters, and to make sure that we can spot these trends as they're happening, and not only when consumers get complaints. The fourth principle relates to transparency. I think there's a few different ways to think about this. First of all, as we mentioned, any new payment system that emerges is going to be different in some important ways from existing payment systems. Funds may move faster. They may be more streamlined. There may be risks and costs that consumers aren't used to encountering that make these payment systems different than other payment systems. It will be very important, not just for any new payment systems, but existing payment systems, to make sure that these costs and risks are clear to consumers so that they can choose the payment mechanisms that are most appropriate to them. Another aspect of this is the status of the payment itself. If something happens in a nanosecond, there may not be any question about, has my fund settled? Has Will received the payment that I sent to him? But that's certainly a challenge that we have in today's payment systems. A consumer may write a check and not know when that money is coming out of his or her account. The same thing can happen with an ACH payment to some degree, although there are time frames for settlement. Certainly happens with some debit and credit card payments. So it'll be important, especially since we don't know what the final payment system products are going to look like, how fast they are, to ensure that consumers do have the ability to know what's the status of their payment, has the payee received it, and vice versa. The fifth principle relates to cost, and here our concern is less about specifying a maximum cost for participation, but more an aspirational goal that cost is not so prohibitive that consumers can't take advantage of it. We would certainly be underwhelming this great opportunity if we build a new, faster payment system that works beautifully, but that only wealthy or commercial entities can enjoy. We have an opportunity here, we believe, through faster funds availability, again, to bring in those that are underserved. And so it's important that the system is developed in a way that doesn't make that cost prohibitive. Another feature about costs that also relates to transparency would be that the costs are recognizable and upfront. Some of the challenges we have in existing payment systems are that some of the most significant costs of, say, using a deposit account for some consumers, overdraft and insufficient fund fees, don't happen until they've made payments and certain results have occurred. Consumers can't always anticipate these costs when they make those payments. Ideally, we can create a payment system that makes all the costs that a consumer can incur much more easier to anticipate. The sixth one I've covered in some: access, making sure that the payment system is broadly accessible to consumers. I think a great debate among many stakeholders is what types of entities would have direct connectivity to any new payment system, be it banks, credit unions, non-depository institutions. I think as we discuss this with other stakeholders, we recognize that there is great security in going through regulated depositories, but want to balance that with ensuring that there is broad access to consumers, and think about how we strive for something that ensures consumers have not only broad but safe access. Number 7 is funds availability, which may seem quite obvious when we talk about faster payment systems. But for those of us that write and interpret rules and really get under the hood, it's important that we don't design a system that just ensures fast transfer of funds from institution A to institution B, but is, as Director Cordray said, actually pocket to pocket. Consumers really don't benefit if the settlement of a transaction has moved up, but they don't get access to funds till next day. And so we want to make sure that we keep the spotlight on all parties involved in the transaction. Number 8 relates to security and payment credential values. I think there's certainly been enough stories in the press related to security breaches, the implementation of Visa and MasterCard's EMV requirements this month that point to the value of ensuring safe access to the payment systems. Here, while we try to be technology or approach agnostic, we certainly recognize the benefits of the tokenization concept, ensuring that a credential that I use to pay Robin ensures that I can properly authorize that payment and my institution can authenticate me. But after that payment goes through, that's of no use to any other party and they can't gain access to my account. Finally, the last is a bit of a mouthful. Strong accountability mechanisms that effectively curtail system misuse. I think we recognize that there is no payment system available in the U.S. today that is 100% specified and regulated by federal rules and laws. There is always going to be, private sector participants that provide access to consumers, one would expect, and the agreements between these participants, whether they be operator rules or network rules or warranties back and forth between the participants, are going to help ensure the safety of this payment system for consumers and others that access it. And so it's important that not only the rules that are set up for the payment system, but also the enforcement and supervisory and monitoring mechanisms are powerful and align with our needs. And importantly, that we define, we can be thoughtful in how things like liability for fraudulent transaction is assigned to parties in the payment system so that the consumer isn't always the first one holding the bag, and that ensures that the other participants that have resources have the same motivation to resolve these issues as consumers do. So with that, I don't know if Will has any color to add or will participate in the Q&A, but those are the principles and which are available online, I suppose is the last. So we look forward to the discussion.
All right, do we have any discussion or comments? Everybody knows me, I can talk forever, but any of the other members of the council want to chime in?
I guess one of the things that I would just say is that I think while smaller institutions are attempting to keep up with, the innovation in this space and to get more involved, one of the challenges is just in figuring out how many we can balance and how many we can support with the limited resources that we have. So as an example, in my institution, we've launched Apple Pay and we're looking at Android and Samsung Pay as well. And also doing some new things with mobile payments and person-to-person transfers and that type of thing. But each one of those processes leads to a new set of things that we need to support in the back office and new ways that we need to also educate our members on how to use all the tools that are now available to them. And in addition to that, there are also challenges along with that in terms of the risks that they present and the amount of security and policy and procedure that needs to be put in place to protect our members afterwards. So it's a careful balancing act to try to figure out what tools that the members are going to prefer. And certainly consumers are going to drive a lot of that process as technology continues to evolve.
And I'm going to follow up on Carrie. I'm going to agree. being a smaller institution, resources is a huge problem. But not only do we face that, is that we face challenges with our vendors. You know, we were always, from years ago, taught to be diverse. You know, have your debit cards over here, your credit cards with one vendor. And now they used to be a lot more collaborative, so they would bring both resources together. But today we have the problem of we have our mobile app with one vendor, and then we have our bill payment with another vendor, and we're trying to bring them both together under one mobile product, but they won't work together anymore. So now you have to have these enormous buyout fees for your contract, or you just sit and wait. And by the time you sit and wait, how much impact is that having on your membership? So that's the problems that we see as a smaller institution.
I'm curious, is it that you have two different vendors because of the desire to diversify, or is there a challenge when you set these applications up, getting them all from your core processor or one single vendor?
I think at the time it was a little bit of both. We wanted diversification, but implementation cost is huge for a smaller institution. So when we looked at one vendor at the time, maybe 5 years ago, the implementation cost was a lot, less. So today, when we're trying to bring it all together to improve the member experience, now you have the buyout cost, which is through the roof. So we have to sit and wait till our contract is up so we can improve the member experience, which in turn, affects their ability to have a improved payment system.
I think one thing we see is the pace of change, which is a challenge. And at our institution, one of our strategic priorities is to remain relevant in the lives of our members. And there's really two ends to that relevancy. One is the folks who want to continue to write checks and continue the systems that have always been in place. And the other is the cutting edge, the bleeding edge technology. Both of those have costs to maintain as an institution. And for us, one of the key issues is the education piece. And you mentioned the fees and the costs and to make sure you're transparent. It's an education challenge to try to educate across and to the diverse groups that you have. And I think one thing that we're fearful of, that I think consumers like the idea of, is the speed of the transaction. The faster the transaction goes, the faster they get the money in their account. Of course, there's a flip side to that as well. The faster the system, the faster it leaves their account as well. And from an institution standpoint, how do we protect our members and make sure those transactions are where they want them to be? And how do we protect our institution? And one thing that we see with a lot of our vendors is that all risk of loss, essentially, they're putting back on the institutions. And I don't know if they're doing that for the very large institutions, but the last few contracts that we've seen have pushed liability for breaches, security breaches that happen on their data, their networks. Those come back to us. And they will only provide coverage for us for some small amount. So that risk really, as we see it, comes back to us because it's not the members who have been involved in the fraud. And one thing you mentioned, Gary, was making sure the right participants bear the loss and not the consumers. And understand that, but my question would be, where do you see that loss resting within the system?
As a matter of theory, obviously you want it resting at the place that is best placed to address it most efficiently. To your point, I think with respect to some of these network systems, you're saying, I think with some justification, that's probably not you. I think that would be the logical place to try to assign it. In almost every case, we think that's not the consumer. There are occasional instances that the rules recognize where it is the consumer, but those are few and far between. I'd be interested in what you thought the potential solution, where you see those incentives getting out of alignment, what you think the right solution to that might be. Is it a governance solution? I don't mean a government solution necessarily, more a governance solution. Are there payment systems that do that better from the small institution point of view than others?
I think there are. I think historically there was some sharing between the institutions, between the contractors, between the insurance companies. And now, as they're being pushed down, they're coming more to the institutions. And from an insurance side, will you hit your deductible? How much are you paying for the fraud insurance? How much will qualify for a fraudulent transaction. And that's what I think really concerns us, is that the bad guys in an instant transaction are gone. And the member may not know it until 20 days later that they've been defrauded, and by that time, the trail's gone cold.
I mean, there's also the difficulty that I'm sure you know well, that no matter where you actually put the allocation risk under the rules, lo and behold, the consumer's going to come back to the institution that they know the best. So, yeah.
You know, often the consumer has gone to the health club or gym to try to get the payment stopped when they haven't been going to that club for a while, for example, and they don't get satisfaction because that health club wants to keep that coming in. So then they wind up coming to us, and we try to regress that the best we can. We make the consumer whole, but it's definitely an issue on what are the rules we've all agreed to, and what's the process to collect on that from the person the bad actor in this example.
I was just going to add to the comment on, we had talked about relevancy and trying to remain relevant for the consumer. And I think another thing that comes into play here is the expense associated with doing that. So as an institution, we can offer these new tools and systems, but convincing the consumer to put us and make us their top of wallet is another cost that comes that's sort of associated with this. So as an example, some of the things that we're doing to drive that is to offer more rewards and cashback checking products and things like that to drive that top of wallet behavior. So it's just an additional cost to not only supporting the payments, but then convincing our members, our consumers, to choose us first.
I'd like to shift gears a little bit and talk about mobile payments. From our credit union's perspective, that's where the game is going. It's going to mobile payments. So we've invested in a credit union initiative called Credit Union Wallet to make that happen. So one of the ways in this kind of creates an interesting challenge for your principals is that in order to pay for the loss of interchange income from Visa as we switch to mobile payments, where the payment is between the consumer comes in with their phone, they've got an account with us, they buy the thing, the money goes directly from the consumer's account to the retailer. In order to make that pay, the model that we're looking at is to use data analytics to provide offers to the retailer and aggregate information that we have about consumer preferences for different retailers, and then go to the retailer and say, hey, I've got X amount of consumers who like your product, can you give them a discount? And in the exchange, we collect the value for the data that we've aggregated, both from the consumer, maybe from the consumer, maybe from the retailer. So the issue that arises there is we've always taken the approach that it's the consumer's data, and they own it, so to speak. And so how are you going to balance as a rule maker this issue of we're essentially monetizing our data in order to replace a business model issue with respect to the loss of interchange income? Most of the data analytics who are looking at this new payment structure, they see that as a very, very powerful engine to replace the lost revenue. The institution, of course, is going to invest a lot of money in the data analytics and figure out how to do that. And then they're going to invest a lot of money in their local retailers to develop those relationships. So there's money being spent by the financial. There is monetary gain to be made by using the data effectively. And so, but it's edging up on that issue of who owns the data, how is the data monetized, and so forth. So I'd be interested in your comments from a principal standpoint.
Very hard issue, I think, frankly. Maybe there's a line in there between the use of data for pure analytics and then the use of data that enables direct targeting to a consumer. That could be a potential distinction. But it's a really hard question as to where the right line in there is.
And then the other issue that we have is permissions. If we make an offer to a consumer and say, you give us permission to use your data in a certain way, then we're going to provide value to you. And so that's another idea. I didn't see the idea of permissions in any of the principles. So that was one comment I would make.
Well, we did. I think, as I mentioned, Kevin, you are hitting on what we thought was one of the most challenging principles on the data and privacy. And you're right, we didn't speak clearly about permissions there. But I think, at least implicit in my mind, was the idea that there's data there, and consumers are going to be able to determine how some of it's used. In other cases, and I don't, again, like Will said, I'm not sure where you draw this line clearly right now, but if there's a benefit and it doesn't really sacrifice anything from the identity of the consumer, and it can be used to subsidize the cost, and it can be used in a way that doesn't really take money from or rights or control for one consumer's pocket for the benefit of others, but it goes back to directly help the consumer. I think you could do it. I think the permissions and some of the other issues. So in some ways, it's a case by case basis. I think in general, as we would with cost or the use of anything or the opt-in, we'd certainly want that to be clear and transparent, and the consumer to be able to make an informed decision so that they can really decide in their best interest.
The security issue here also complicates things because obviously you certainly want data used for security purposes, and that may not be a place where permissions are fully appropriate because it may be very hard to explain all the various ways in which that can happen. So that, I think, potentially complicates it. But you could link those two approaches. There could be the approach where pure analytics, maybe you don't need consent. Once you're outside of the pure analytics mode, maybe you do need consent.
One of the issues with the mobile, we are implementing Apple Pay. We're also in the process of implementing the CU Wallet, which is the network-owned system. Talk about the fraud within Apple Pay and the consumer's rights, chargeback rights or redress rights. When that transaction occurs, it's between the consumer authorizes Apple to do that transaction. So the data on what specific transaction occurred and where it occurred is with Apple. All we see is a transaction with Apple pulling that money out of their account. We don't see that they went to a particular store or online retailer if they use their Apple account. With our CU Wallet, that's a direct. We see the transaction. We know exactly where they shop. So if they have an issue with it, we can then address that on their behalf like we would for a Visa or MasterCard. But with Apple Pay or Samsung Pay, they have that transaction set there. We don't know anything about where that occurred. We only know Apple said, hey, we need to put money into their Apple account to reimburse it for the transaction that we handled for them.
So you don't see the merchant code or the SKU code or anything like
Not
that?
on Apple Pay, no.
On Apple Pay.
So, yeah, I've been hearing this from some institutions, certain larger institutions in particular, their concern about some of these payment mechanisms that essentially they're disaggregating the transaction such that, as you described it with Apple Pay, for example, they end up sort of having the customer relationship and the valuable customer data. You don't have it, yet you're still considered to be responsible on the back end for the error correction, fraud resolution, and the like. There's a lot of concern about whether what this does to the financial institution's role in that payments mechanism, and whether the responsibilities of some of these payment methods, the people providing them, whether it's Apple Pay, Google Wallet, are commensurate with the obligations. And I just wondered if any of you have a reaction to that.
We all probably have very strong reactions to that. But I'll let some other people comment who had direct experience.
I don't have a direct experience, but obviously that's very troublesome. I did not know that. I'm glad now that I didn't go in the iPay way when the early adopters. That's very, very much problematic for institutions as a whole.
The other area that's problematic, I think there's a lot of, and I'm glad that you publishing these principles, because there's a tremendous, well, I almost think it's a bubble in what's called fintech. I mean, we're all familiar with that term. A lot of companies coming into the space, a lot of anticipation of extraordinary profits and stock prices going up, I guess, for want of a better word. And yet, it's difficult for us to comment. For example, Venmo is very popular among the younger set right now. And, I was at a meeting, and a young journalist came up and was asking me about Venmo, and I was trying to explain to her that Venmo is not secure. And she just didn't understand that. And we deal with a lot of the Venmo hacks, where so that's just one example, but all this innovation that's happening in the space with non-regulated entities, and then we're sort of left picking up the pieces. I mean, that's one of the things that's very frustrating for financials right now. So any comments you might have about that?
No, I think it's interesting to hear about Apple Pay and Venmo in that context. And I wonder if there's a distinction whether you see any that do provide that kind of information to you, the pass-through information. Are there better actors in that space, or is it essentially the same problem? Because it's existed obviously for a while before with disintermediators like PayPal. It's not completely new. It may be worsening as a problem, but
Yeah, no, it's an issue, and PayPal is a good example because well, the data, everyone realizes how valuable the data is, and once you have the data, you don't want to give it up or give it to anybody else. And that's the issue, and PayPal is a good example of that. I mean, we've talked to them, and no way you're going to get that data. No way.
you still have to resolve the errors.
That's correct.
Even even think about the consumer going back and look at their PFM or their aggregate of all their transactions. They don't even know where to place it into what category, so they can't even do their own budgeting or balancing of their own checkbook. 'Cause they may not even recognize what that transaction was at some point in the past.
The other issue I've been hearing about is the screen scrapers who end up very often getting consumers to grant them sort of a wide range of credentials, going beyond even the particular financial institution, but other passwords for other financial relationships they may have. What's your level of concern around maybe sort of the casualness with which the consumer regards the security issues? They may not fully appreciate what they're doing as they grant credentials. They see the convenience it can create, but they don't necessarily appreciate the risk. Any experience with that or reactions?
That would tend to fall under personal accountability, and that's a concept in America that's been dead for years. So,
Well, I
I
think
would say it's still there. It's perhaps compromised a bit.
Well, I think the other thing that I would add to that is that consumers in general have become less concerned and almost somewhat immune to the impacts of breaches and things of that nature. And I think that they're just becoming desensitized. But I also think that they're more willing to trust brands that they're familiar with, or again, look to kind of the shiny object or the thing that'll make their lives easier right now. And they're not exactly appreciating all of that security as much. And I think some of that is just because of the history of the breaches and things that have occurred. If they know that millions of people, had their social security numbers compromised or all of their personal information, they're, I guess, again, desensitized, I think, to some of that and not as concerned about it. And that's where we need to figure out how to create some of that protection, I think.
I think that's a great point, and it's something we all should be concerned about, which is the consumer getting desensitized to some of these risks? I mean, I see it, for example, in different contexts with the product recalls in the auto market. There's so many of them all the time that you almost become numb to them. Each one doesn't make much of an impression. And I wonder if the same is happening as people grow sort of fatigued with passwords and other things, and they're sharing information maybe more freely than they intend or than they recognize they're doing. I wonder about that.
Imagine when the consumer becomes desensitized to the fact that the financial institution is the one that's ultimately on the hook for those losses, and they become even more cavalier with their online login information or the personal data and so on. We're the ones left holding the bag at this point.
Do you think that I'm sorry, do you think, so I can certainly see that. I mean, it makes sense to me. I would also anticipate that, consumers just might not appreciate the value of those credentials until something has happened. And so that it would appear that there could be a very narrow window, given how quickly, one fraudulent event could then spiral into several, that there's a teachable moment there. I guess I'm curious whether, what does that imply for when the teachable moment really is for the consumer? I mean, obviously it should be never to do it, but I think we all appreciate that sometimes you have to learn by example. And so as much as we say it, it might not settle in until something's happened, or do you feel otherwise?
It's like backing up your hard drive. Once you've had a crash and you've lost all your pictures and all, then you enter that discipline. But until that point, you don't.
The other thing I would add to that, though, and back to the kind of desensitization issue, is the speed at which we as financial institutions respond, which is actually very positive. But at the same time, if they can have a new credit card replaced the next day and have their account information switched over so quickly, it also becomes less of an event for them. So maybe a lot of transactions happen, but when we're fixing it as quickly as we are, I think it's also, oh, okay, well, that happened, and they can move on.
It does feel, I'm sure, a lot of times that the better job you do, the less it's appreciated and the more it's taken for granted. And I'm sure that there's been a lot of heartburn, I've heard it, with the retailer breaches, that ultimately it's the banks who end up fixing it for people at considerable cost at times. And people end up potentially angry with the credit union or the bank for difficulties in solving a situation that you had played no part in creating. It's interesting to think about these different pieces of the financial system and how they're hooking together, and whether there's sort of equity and or appropriate responsibility in all pieces of it. And I think the point that you made, Kevin, about the distinction between sort of credit unions and other financial institutions who are regulated in a certain way, and some of these new players who may be, being created in the cracks, maybe falling into the cracks, becomes incumbent on us as regulators to think about how we try to create a level playing field across the system. And it's difficult to keep up with and understand and appreciate all the aspects of these innovations. It creates a real challenge for us, as I believe it does for you too.
I think it's important, though, too, that we maintain the distinction between the fraud stream that emanates from a member doing something that they maybe shouldn't have been doing, maybe careless handling of their card, careless handling of their information. When that happens, that's between us and the member. And how we respond to that and what we do and what we don't do. Again, that's a financial institution to member relationship, and we value the relationship, we fix it, and we move forward. If it happens the third, the fourth, the fifth time, we have a decision to make. But I think we shouldn't be too quick to commingle that with the breach type of things that happen with some of the major retailers. We don't need to mention names here. Everybody in the public knows who's been impacted. And it's not as though I don't have some amount of sympathy for these people. They're clearly being targeted by the criminal element. But a major breach occurs at a significant sized department store across the United States, and it's financial institutions across America that get hit with those expenses. That's just plain not fair. And this is against an environment where, as part of the Dodd-Frank law, we had the Durbin Amendment. Now, the Durbin Amendment didn't hit many of the people in this room directly, but the retailers aren't done with Durbin type of activities and looking for ways to constantly get at our interchange, which is really the only buffer that we have that helps us to absorb these fraud costs. So I think we've got two very different problems there, and I hope that the solutions to those are very different. The financial institution to member, I think that's ours. We own it. We deal with it. But the bigger breaches, the merchant-caused frauds, somebody needs to help us with those.
In that respect, I think it's important that we look at MasterCard and Visa, and I don't know if I'm supposed to say names, but they often know way ahead of time that there was a breach, and yet they don't inform us because they're doing what they call their due diligence, and it's been known to take 3 to 6 months. In the meantime, consumers have been impacted because their debit cards been, and we're taking greater losses. And my response to them was, just send us the list of cards that were compromised. You don't have to tell me who the retailer is. I don't care at that point. I just want to protect my consumer, my member, and I want to protect my institution. But they don't. They leave that hanging for so long, and if they would just respond quicker and let us know, there'd be a lot less impact to the consumers.
To follow up on Robin's comment, we can't even let our members know if we know the common point of compromise. We have a data analytics system that we can see where it is. And we have one of our directors had a regular lunch at a restaurant in town that had been compromised. And the third time he came in a third week in a row, his question was, what is wrong with your security? It's our reputational risk, and we couldn't tell him, don't use your card there. But it's that type of behavior that we know where it is. We can tell, we can't disclose to the member, suggest that they not go there, suggest they do something different, but we take the reputational hit because our director had his card replaced 3 times in 3 weeks.
In the third quarter of 2013, there was one of these major breaches, and the information was coming to us in trickles. We were getting a file today, a file tomorrow, a file a week from now, telling us which members had been impacted. One of our vendors in that space, through their own analytics, within a week or two, had identified every member who was potential to that compromise and had put them on a totally different type of fraud watch program, which was extremely important to us and enabled us to attack the problem differently. So there are solutions that are out there. It's just a matter of people like this putting their heads together and trying to come up with them.
Where do you think the data block is? At what stage? I mean, if a breach takes place at a merchant, is it not getting from the merchant? Is the part that's too slow? Is it the merchant to the network to you?
I believe it's the network to us, or the network to some of our providers to us. I think that's where the problem is. But this particular vendor that we do business with just simply went in and scrubbed the files, looking for cardholders at our institutions who had shopped at this particular store during what everybody who read a newspaper knew was the affected period of time. If you stop and think about the data search, it wasn't all that complicated. And then they flagged all of the accounts that were potential to this breach and monitored them differently through their fraud watch program.
An interesting aspect of this discussion to me is we've developed this set of principles as applies to consumers, and that's sort of our role and focus. It does occur to me that somewhere in this relook at the payment system and as it evolves, there needs to be principles about what's fair to institutions and financial institutions as well. I don't know that that's for us to say, but as we're having those discussions, certainly some of the same principles that apply to consumers about access and transparency and the like feel like they may apply to you as you're dealing with multiple points in the system as well.
I think just even to go back to a very old technology that is going to come under a microscope as we move to a faster payment system, the ACH system. Right now, our ACH settlement is done pretty much in a batch type of file, and we're looking at that on a once-a-day type of system. And we're moving in a direction when, in the not-too-distant future, we're going to be dealing with instant settlement. There's a lot of inaccuracy in that system. And the inaccuracy, again, falls to us to resolve, and especially if we're interested in providing good member service, it falls to us to resolve. But there's a lot of misinformation fed into that system. When you stop and think about the credit card or the debit card system, for example, there's a uniform record length. Everybody knows what the uniform record length is. It's very difficult to pass bad information unintentionally through the system. But when you're talking about the ACH system as it currently exists, you fill out a form at your employer, or you go online on a PeopleSoft type of system with your employer, and you key in the routing and transit number of the financial institution and the bank account number, your bank account number, in our case, credit union account number. The number of or incorrect, let me say it that way, numbers that we see in our files right now is staggering. And we have ways of dealing with that. Some of them are within the ACH system, and some of them may be a little bit outside of the system. But if we're going to go to an instant settlement, that whole thing somehow needs to be remedied.
We actually have been talking with the clearinghouse on the ACH system. They're moving very fast toward a real-time payment system. I think that they're very mindful of some of the issues you're raising. They're actually working on a time frame that's much faster than anything else I've seen for any other part of the payment system. Of course, some of the perspective on this that Gary and Will know very well, better than I. If you look around the world, there are quite a few real-time payment systems in other countries, and they've been in effect in some cases for a while. I think there was enough general satisfaction with our system. People did not want to make the investment of going there, but I think people are beginning to understand that for competitive reasons and otherwise. This is a move that people need to make, and they're feeling varying senses of urgency about it.
And the ACH system brings a huge cost benefit because they're a very low-cost provider, and we really need to squeeze those costs out because Visa and MasterCard aren't. They're very expensive and they're very rigid and don't want to talk to us and give us any flexibility in pricing. And then when you add an Apple Pay fee, it's on top of the Visa or MasterCard fee. So the transaction costs are very, very steep. ACH has a nice, better cost model, and getting them aligned to resolve some of the data issues, the chargeback right issues, would be a big benefit.
As we change to a faster ACH system, I think a huge part of that is going to be consumer education. Because I believe somebody said earlier, when you write a check and they convert it to ACH, consumers don't understand that that money's coming out their account right away versus they're used to the float. I wrote the check, normally I got 5 or 7 days before it clears, my payroll will be in, I won't get hit with a fee. So as we move forward with a faster system, there's going to have to be a lot of education to the consumer because it's definitely going to be a behavior change for them when they're used to that float.
Or disclosures at the retailer saying that I'm converting this and it could come out of your account immediately. It can't just be on our end, it's got to be on retail end too.
This is a very interesting point. What are some of the things that you all are doing to inform your members about the impact associated with real-time access? Are there things that you've learned as you've engaged with your members on this topic?
I think for us, a lot of what we've done on the online services have helped our members. They can see if they go online what pending transactions are coming out their account. They can see what day their payroll's going to post ACH. So it's a matter of them utilizing the tools. And that alone, too, is education. We do the workshops on a quarterly basis to educate them on the tools that we have. But sometimes you get so caught up in convenience, or time is the essence for all of us, of taking the time to understand what we have. But we do that. We do workshops. It is online so that they can understand that they could truly see the real-time effect of their transactions.
The effect of people being able to review their accounts online has been, moves in this direction. I mean, if I'm understanding you, and what I've seen is you'll have certain, you go to look at your balance, you'll see certain transactions that have occurred. You'll see other ones that are marked pending. You don't necessarily know exactly when they're going to hit, but you know that they haven't hit yet, but they will hit. You'll then be able to see when they have hit. The one piece you don't yet know is when it's pending, how long it will be pending. Real time will ultimately eliminate all of that uncertainty for the consumer, which we think is one of the beneficial aspects of it, if these other pieces, fraud and other things, can be managed in the system. But it is true that it's more transparent to the consumer than it used to be. Used to be all they knew was what had already moved through, and they didn't have any real sense of what else was pending, and you know, maybe they had a experiential sense of how long things tended to take, but never was it very specific. It reminds me of in the soccer games when they have the extra injury time and you don't really know how much time it is, you know? I mean, should you rush down the field and try to score in 10 seconds, or is it really 50 seconds? Or, you know, to me, you know, I think the American mindset is we regard that as pretty subpar. We want, you know, we want the tenths of seconds in the last few seconds. And I think consumers probably expect and feel they're entitled to that, and it's kind of frustrating at times for them that they can only know portions of this and not all of it. So.
I think a lot of financial institutions have converted to real-time debit card transactions, real-time credit card transactions. So if I'm going to Walmart and I'm using my debit card, it's immediately coming out of my account. Now, there are some cases, and we talked about it at our meeting earlier, where I use my card to buy an airplane ticket and they, you know, freeze my account. They put a hold on it, but then they also debit my account for the same amount of money. So that does create problems of funds availability because consumers don't understand that. But on our end, they don't see it that US Air put a hold on their account. They see it that we put a hold on their account and they got hit with a fee. So again, it's just, I'm a big believer in just continuous education for the consumer.
I'm curious, because the ability, like you said, the moving to be able to post on a real-time basis debit card transactions and things, whereas, you know, you may have, I'm sure, have had online banking and the ability to see transactions for quite a while, probably also alerts but that this information is becoming more timely. And whether you have observed, it was moderately helpful to consumers until we started showing these things midday, or we used to send alerts out on a nightly basis, but now we can do that on in the middle of the day, and we found that consumers benefit from that. I don't know if you've identified any kind of step function opportunities where the concept was always good, but now the delivery of it is so much better, and we really think consumers are benefiting.
One of the products we offer our members is a bill pay service, and one of the features they have is that they can schedule that bill to be posted at the credit or the merchants at a particular date, or they can ask to have it withdrawn at a certain date. So they have a lot of control over that, and they can see exactly when it's going to be taken out of their account and be posted on the other end. Features within there include all the text alerts and mobile alerts, email alerts, and with today's technology, the variety of alerts that they can get from every single transaction as it occurs to a daily balance file alert is pretty impressive in what we are able to offer our members today, to put that control in their hands. And as long as they do their banking through our bill pay as opposed to doing a pre-authorized with the merchant, they see it and they know exactly and they can control it. When it's with the merchant, it's a pending transaction that's up in the air.
Yeah, then they lose all control, right? They don't know when it's going to happen, and they can't predict around it. Yeah, it's different.
We've also added for our debit cards, it's a software where they can turn their card off anytime they want. They can determine any certain types of vendors they want to turn off or on. They can turn it off and on by geographic area, so when they're traveling, my card's only good in this area, and we found that that's really helped reduce a lot of the fraud also.
So back to a previous statement that Maria made, in addition to the training, et cetera, we found that our members rely really heavily on the alerts, and we've got a lot of custom alerts. They can sign up for them themselves. They can set up, a daily balance that they receive every day, a low balance trigger whenever they go below a certain amount, or even transaction specific, when does this item clear? So that's been really beneficial in addition to the education piece.
One of the things that we've struggled with, we have something similar to what Robin discussed, where you can turn your cards off and on, where you can do the geofencing. We have, as a former airline credit union, we have members all over the world at any given time. And so what we see a lot with the cards is that if there is fraud coming in through some country, the credit card companies, the MasterCard, Visa, will shut down that country. And so we get the nice calls in the middle of the night, someone leaving us a message saying, I'm here, can't get into my hotel. So that's a challenge for us, is to try to maintain a membership that could be anywhere in the world at any given time. Ideally they let you know, but sometimes they just get shut down. So.
The remarkable thing there is how this compares to the perception and sort of perspective that consumers have. I mean, at one time, this was all incredibly difficult. They now sort of expect it all to be pretty easy, and of course it's not always easy, but it's so much easier than it was. It's almost like expectations have outrun sometimes the reality of things. It's actually a hard thing to transactions across borders, different countries, different laws, et cetera, and somehow they've been made fairly seamless, which is rather remarkable.
And you take that back to my initial comment of remaining relevant, and those folks are so far ahead of where we really are today and where we can have control over, but then you still have those who want to use the standard regular route. And I think in the payment systems world, Carrie made the comment of you've got to determine what all you can do. And if you polled our members, regardless of size, I think our members would say, I want you to do it all. I saw this really neat feature on this ad during the Super Bowl, which none of us could afford to do. That's what we're expected to keep up with and maintain it in a cost-effective method. So I think that's a challenge we face, and that circles back to education as well.
Yeah, to echo the education and going back to the alerts and the pending transactions, we do all that also. But to go back to your personal accountability, what we found out is that nobody balances their checkbook anymore. Nobody takes that responsibility to really see what money they've got, because they just pull up their app, they pull up the mobile banking, and they see the balance, and that's what they go with. So education is extremely key to remind people to take into account everything that they've done.
Yeah, that's not balancing your checkbook. I know is a sore subject for Director Cordray, because I think we learned in conversations like this he was distraught by how many people aren't doing that anymore.
And I was also distraught at recognizing that I still do it very carefully, and it may be serving very little purpose. So,
But on top of that, I think your point's a great one, because I've in other conversations I've had, I've also had a similar sense that consumers may interact with their institution very frequently. They're constantly looking at their balance. But if they're only looking at their balance and not their pending transactions, they can be going through the motions but not getting the information to make decisions wisely. And it seems to me, the behavior of at least getting them to check should be a positive thing. And now maybe the challenge is just saying, when you check, here's how you should check, kind of thing.
It's that issue between ledger balance and actual balance or bank balance. Question for you on the transparency. As we move to formats that I'm looking on my cell phone, as I want to obtain this new technology, thoughts as to how to make sure that the consumers really understand and read through and scroll through everything, make sure they read it on Reg Z. For some things, you're offset, you're bold, it has to be very obvious. Thoughts from you on how we address this as we move forward with these new payment technologies?
Well,
Oh, sorry. Just to add to that really quick is how long some of them are, kind of to your point, is how do you highlight what's actually really important? Because some of them are like, oh, here's a 72-page document, and how many people read that on their phone? Probably not too many.
So a couple of points. Obviously, with some, in places where we're newly making rules, like in the prepaid space, we've very deliberately tried to design short-form disclosures that are intended in part to work both on a JHOOK and on a mobile screen. But obviously that's not the case with respect to every reg and every product out there. I think one thing that we have done that people haven't noticed that I think we'd hoped perhaps people would have taken more advantage of is we have a trial disclosure program that lets you apply to do a disclosure that might not be within the model form, right? It might look a little bit differently. And one of the things that I think we thought that we would see is people saying, look, these new form factors let you do interactive, timely, interventionist disclosure of a completely different kind than static paper. But we think we've got a better mousetrap here, but we're not completely comfortable if it's 100% on all fours with the rule. We think it is, but we're not completely sure. Could you give us a check on this and let us see how it works in practice and then tell you how it works in practice? We have that framework, and we're very interested in ideas that people have.
Well, let me bring up a kind of a more macro subject then, since we've been talking about a lot of detail. One of the things we've been discussing is the fact that there's lots of change in the marketplace. Consumers are demanding new products and new services. The financials we cannot necessarily charge our real costs or cost plus margin for these new products because we're competing with so many different competitors. And so what a financial naturally does is it seeks to optimize the revenue streams that it has that consumers are used to. And those revenue streams actually subsidize these other activities. So, and it's a constantly evolving and moving target. And then regulators maybe come in and say, hey, you know what, your revenue streams from these legacy, let's call them legacy sources, are too high. They're too extraordinary. They don't really reflect what your actual costs are for these legacy systems. And yet we're covering all these fraud costs, we're covering the new stuff. So it's an interesting dynamic in the financial services industry that we try to optimize the revenue streams from legacy systems, legacy processes that consumers are used to and are comfortable with and they accept, to pay for the new stuff and to pay for new fraud things and new costs that we have that are unexpected, because we can't we can't go to the consumer and say, hey, you know what, we have a new fraud fee. We're going to charge you for all the fraud we expensed last year. So as a regulator, that's one of the balances you try to strike, is to do that back and forth. I'm just interested in your reaction to that systemic effect of our financial institution marketplace.
I think I sympathize with it. There's a challenge, first of all, especially when you talk about new payment systems, you have to get enough access and availability of the system, and then enough transaction flow to really justify it. And it's hard to do that if you start putting a premium on it that dissuades consumers from using something that's beneficial. And so I think time and time again, we've seen new innovations in financial services being offered for consumers and businesses to try to get volume. And then at that point, it's hard to put a price tag on it. And that creates a great challenge, because we have, we don't have in the consumer marketplace often a place where consumers pay for what they use. So we certainly see, that in checking accounts, there's cross subsidization, and I'm sure in other products as well. I do think, I've always felt that it's not so much the case on the commercial side, right? You don't get anything for free, or used to not get anything for free if you were a commercial entity. And there, you had sophisticated CFOs that could appreciate buying insurance or buying fraud protection and things like that. And we've seen some vendors come by with some applications for consumers, maybe like the ones that you're describing for your card fencing, but also for ACH, that would let a consumer intraday determine whether or not, yes, these incoming ACH transactions really are authorized, and yes, I want to pay them, or, and you could default that one way or the other. It'd be a hard business case to sell that to a consumer unless they've really had a lot of unauthorized transactions, and you need that volume to get there. So I think it's a big challenge. I don't know. Maybe Will has an obvious answer. I don't have one there, but I think that one thing that we want to be certain about as these new payment systems develop is it'll be important that they don't. It'll be interesting to see how ambitious they are at first. The Fed and their consultants defined a number of different use cases, not all of which are involve consumers, but most of which. And you could have payments made to consumers, payments made by consumers to other consumers, and so forth. And in an ideal world, if you can design a system that meets specific needs, you might be able to do it in a more cost-effective way. But I think we all recognize that whatever's developed is going to be used for other means, and so it's a hard issue.
And obviously, you're competing with players who are trying to build massive scale and then worry about how to monetize it later. So it's really hard.
So that means you're going to be sympathetic with some of our legacy revenue streams like ODP, right?
Well, yeah. So
I had a sense it was going there. Yeah.
Yeah. So I could offer you my views on some of this. I think that there's I think we many of us would draw a big distinction between that the aspiration doesn't necessarily have to be free, but the ideal is that the costs are recognizable, and that a consumer can make financial decisions, know what those costs are, know what they can incur them if they can't. So working on another project, and we were talking about deposit fees. I mean, clearly a monthly maintenance fee, forget about for a fact if it's triggered by a balance that, that you could have all kinds of hair triggers that determines whether or not you get charged a fee. But if you know you get charged a fee on a regular basis, you can budget for that. You can do that. A transactional fee, you could budget on a per transaction basis, but you might not know how many times I'm going to go to a foreign ATM this month or use my prepaid card, and that's a little harder. Overdraft fees, by comparison, you likely don't budget for. I mean, there may be instances, and I'm sure you can tell us, where consumers are seemingly knowingly overdrawing, but in many cases they're saying, well, if this payment comes in before this check goes out or this happens, I think I might get there. And then there's, I thought I might overdraft, but I didn't think I'd overdraft 5 times. And so, I think ideally we move to a world where if there are costs, They're ones that can be anticipated, budgeted, and navigated, so that consumers can make most informed decisions about what they're using. But that doesn't necessarily mean that everything has to be free, in my personal opinion.
Most of us now use systems to look at the totality of the relationship so that we can see which members or households are carrying their own weight versus ones that are costing our membership money, and try to grow it. So we want that checking account, use your debit card, have your car loan with us or a money market or a certificate with us. Do more than just an a la carte service, because that's when you get into trouble with profitability. And the costs of carrying a single service account are so great that we either want to move them up or we look to move them off because we just can't afford to continue to carry that.
It's interesting to me, it seems, as I look at this dynamic in the market, that a lot of the business opportunity for financial institutions is to cross-sell their own customers, or in your case, members, other products. And for them to be comfortable wanting to do that kind of hinges on excellent customer service and the products you are delivering to them. To me, that's potentially a virtuous circle. But I think it's growing increasingly difficult for you to succeed if you're not in a position to capture more of that member relationship with the institution. So.
Well, it looks like we're getting close to the end. Any final comments from anyone? All right, so thanks for everyone for a great discussion. This concludes our meeting of the CFPB's Credit Union Advisory Council. Thanks again for everybody's time and interesting discussion, and have a great day.